Hi, this is DawnBlalack with Coldwell Banker, and I've got Hendrix here with Stearns. He does loan originations. That's mortgages for people who don't understand what that means. And he's going to give us some tips and go through some of the initial buyer process so we have a better idea of what people should look forward to. All right, so let's talk about credit score, because I think people think they've got to have like an 800 credit score to make a purchase.
So on the credit score, you don't even have to have a credit score to qualify. We have a program here at Stearns that has a no credit score. So say someone that just hasn't had any open accounts, but they have utility bills or cell phone bills.
So that buyer who does everything by cash?
Correct.
So they got rid of all their debt doing the cash thing, and then suddenly they
Dave Ramsey folks, and so if they have, we can use alternate credit. So like I mentioned, utility bills, cell phone bills, your current rent history, that kind of thing. So no score is fine. Even a lower score, we can go as low as 580 on certain products.
Okay.
And so it doesn't have to be in your 800s or anything to qualify.
That's great.
It can impact interest rate and things like that. The higher your score is, maybe the better rate you get, but it doesn't exclude you from getting a loan with a lower score.
That's awesome.
And sometimes, people are credit challenged and they have a 560 score or a 540 score. Well, they could still get pre-qualified with me, and I can give them a path to get their credit score back up to where it needs to be, whether it is paying off debt, paying off collections, that kind of thing. Getting open accounts that actually get a positive credit history, that kind of thing. Medical bills, medical collections they hit your score, but they don't really impact the approval, because everyone realizes that medical bills happen and collections and those kind of just get passed under the table.
Okay, great. And what things do they need to have to do an application? What type of paperwork do they need to have? How's that work?
As little as none, actually. They can go, if they go through the website, my website, to apply, we can pull those electronically from their employer and also their bank accounts. So if they did it in person, they would bring me W-2s, pay stubs, and bank statements. And that's really the only thing that we need to get started for an application.
Great. And what are the steps? So kind of give me through, what are your steps? How long does it take?
If you apply, basically 3 different ways you can apply. If you do it online, you can fill out an application online, and like I mentioned, pull your employment history and your bank accounts statements right through there. You can do it in person or over the phone with me. Any way you go, it's only going to take you about 10 minutes to fill out the application for me to get the application from you. And then that's all there is to that.
Okay. How long does it take for you to get an approval back to them?
In most cases, within a day, I can get a pre-approval through our automated underwriting system to see if they're qualifying or whatnot. Sometimes people's incomes are different, so they start a brand new job and it doesn't fire an automated approval that is really acceptable. At Stearns, we can actually send the whole file to an underwriter, which is unique to most lenders. Where our underwriter, the same underwriter, if you bought a house or whatever, is going to look at that information and condition it out and say you're either okay or you're not. And an underwriter is a person that basically makes sure that we're following the guidelines and that your loan fits the guidelines.
Okay, and could you go over some of the reasons why someone should get pre-approved before they really start going out there and looking?
Well, first off, it's the payment that you might be comfortable with we might be able to qualify you for higher. So, first of all, you want to know what loan you qualify for, which dictates, down payment,
types of properties,
that kind of thing. And as well as, the price range, like I mentioned, you might be looking in a higher price range but not be able to afford it. Well, there's no sense in wasting your time looking at that dream house that you might not be able to afford. And conversely, if you might be able to afford way more than you think you do, that's another reason to get pre-qualified. Another reason, when you get pre-qualified and you submit an offer, it's a lot stronger of an offer than it is someone that submits an offer without pre-qualifying. That's
very, very true. there's some where they won't even take an offer unless it's pre-qualified, and some homes you can't even look at unless you're pre-qualified.
And it also lets the agent know that you're qualified and not wasting Dawn's time either.
Yep. And you did mention that, some people qualify for a lot more than they want to spend, so that they can kind of figure out where that price point is that's going to make them comfortable.
And that's the first
on a
question
monthly.
I ask a borrower is, what are you comfortable with for a payment? Because that's really the most important.
Yep.
We don't want to put somebody in a position where they can afford it on paper, but not in reality.
Very true. Very true. How can they keep things going? So once they've gotten a pre-approval and all of that, what do they need to do to keep that smooth?
Yeah, so once you get a pre-approval with me, basically the only things that expire is like a credit report, which will last 4 months. And we always like to have the current pay stubs, current bank statements, that kind of thing for those items. So those are things that get refreshed along the way. But there's also behaviors that you might want to avoid once you have a pre-qualification, because if I qualify you today and tomorrow you go buy a new car, you might not be qualified anymore. So that's one thing to keep in mind is pay your bills on time. Try to avoid any new debts, any new credit inquiries, that kind of thing. And don't buy that new car until after you close on the house. It'd be don't get the new credit card, because then it definitely affects your credit and your credit score, and then we have to get your items there. So.
Okay. And if they're planning on changing a job, let's say we've got something under contract and they get a new job opportunity, how does that affect them?
Well, basically, I would say avoid it if possible, but in reality, hey, if you got that new job and it's a better job, then absolutely take it. Just know that you're going to need updated documentation, that we're going to need, pay stubs, verification from your new employer as far as what rate you make and that kind of thing. So it's just make sure you get ahead of it. That would be my biggest advice on that.
So make sure that they're talking to you and keeping you informed if they're planning on changing a job, retiring, any of that before they suddenly do it and we're at the closing point and they say, hey, you don't still work here.
And don't quit your job. That's actually happened. I've heard a war story of someone got to the closing table and they had signed. Signing doesn't necessarily mean closing until it records at the courthouse. Well, they were signing one day, closing the next. They signed that day, guy quit his job. The next day, it wasn't my company, but another company did a verification of employment. They said, no, he no longer works here. Buy loan, buy house. So,
oh, man.
Don't quit your job.
Yeah. And what does a mortgage payment, because I know you can go online and you can look at, oh, this is the mortgage and it looks like it's some small amount, and then when they get to the closing statement, it's like, what do you mean I'm paying this amount? So what all does a real mortgage?
So the mortgage payment has the principal and interest, which is the loan and the interest in the loan. It also, in most cases, includes the taxes, the property taxes for the property, and the hazard insurance for the property. Most people choose to escrow that. On government loans, it's required. So we pay your taxes and we pay your insurance on your behalf when they're due. So when November comes around and that property tax bill is due, you don't have to write a check for $1,800. We pay it on your behalf and we collect it in 12-month increments to have that money available. The other thing that maybe is mortgage insurance. And anytime that you have less than 20% down, there's a mortgage insurance. Whether it's private mortgage insurance through a conventional loan or mortgage insurance premium through the FHA program. This is to ensure that there's at least 20% equity in the property. So worst case, you get foreclosed upon, you lose your home, that mortgage insurance premium kicks in to pay that bill down to 80% of what the home was purchased for, so that way the home's marketable for a foreclosure.
Okay. And when they get to the closing statement and you pre-collect some stuff, right?
Correct. So say if the taxes are due in November, we have to have enough in that account to make that payment when they are due. Well, if you close in October, we need the full year's taxes in November. So we collect up front enough money to pay those bills, whether it be insurance or taxes, and that way we have enough money when they
Right.
become due.
So people need to be aware of that, so they're not thinking, oh, I'm doing this, and then suddenly they get,
And that's a
where does that come
significant
from?
piece of the closing costs that, is getting that buffer to make sure you have enough money to pay your taxes and your insurance.
Awesome. Well, thanks so much, Kurt. And if anybody wants more information or Kurt's contact information, just PM me. Thanks.
Thank you.